everybody. Today is a great day. It's not only a great day, it's one of my favorite days because I get to talk with one of my good buddies who has actually been a retread. This is his second time on the Energy Newsbeat podcast. My name's Stu Turley, President and CEO of the Sandstone Group, and we've got Steve Blackwell. He's the CEO and co-founder of Inveto Energy Corporation, and we've got some really pretty cool stuff to cover in the investing markets. Steve, welcome.
Thank you, Stu. It's always a pleasure to be invited on. Thank you for asking me to be back. I don't know how I feel about being a retread, but I'll take it. So looking forward to having a discussion.
Retreads are fabulous. That means that you evidently had a good time on the first one. And that podcast went off really well. And so we've got several major issues to cover right now. We've got, everybody's talking about SVB. And when you talk about bank concerns, I'm dealing with a lot of folks as well as you are. You're talking to a lot of folks. You were just at a presentation on a panel. We want to cover that. We want to cover also what's going on with the markets, and then what we're seeing as what people are really concerned about in investments for tax deductions and concern about the bank and everything. So we've got a lot of things to cover here. Steve, tell us a little bit about why you started Inveto Energy Partners and what is Invito?
So I started Inveto Energy Partners really the latter part of 2019. So not exactly the greatest timing right before COVID hit. But, who predicted that? Nobody. If they said they did, they're lying. But myself and my partner, Jared Christensen, we had worked together at two previous companies, one where I was the president of Petromax Operating, and then I was the COO of another company called US Energy. And Jared essentially ran operations for me at both of those companies. And Jared's got a deep background. He's a petroleum engineer. Started in the kind of the mid-sized public companies, Unit Petroleum, worked for one of the big guys in Canada, drilled wells all over the country. But anyways, we've known each other a good decade now, built a good relationship, kind of think the same about the business.
Right.
And really coming into 2019, when we were considering, maybe starting something on our own, the first question you have to ask in any business, particularly in oil and gas, which is capital intensive, is where are you going to get capital? So we kicked around a number of different ideas, kind of looked at the private equity landscape, didn't really look appealing to us, quite honestly, because the valuation and the exit strategies just weren't the same that they were in the previous 10 years. Right. And so that really just felt like going to work for somebody. And both of us kind of were in that place in our career where it's like, it's time to give something your own, give something a shot on your own and run your own show. So, and build something that feel, take ownership in and feel good about, and the people like to work. So really it was a desire to build a company that we enjoyed working at, that the people we work with enjoyed working at. And also we kind of looked at the private investment space, and based upon our experiences, felt like there was kind of a need in that space to do things and structure deals a little bit differently. So that's why we started. Unfortunately, we started right before COVID. So 2020 was kind of a waste of time. But, last year was really our first year having funds on the street and raising capital. So,
Steve, the only good thing that came out of COVID was the podcasting and the I don't have business meetings anymore that's not on Zoom. And I thoroughly enjoyed that from that aspect side of it. So, people got used to it, and as opposed to just doing phone calls. And so tell us a little bit about, Steve, I've enjoyed getting to see your articles that go out there. Your Substack, we'll have that in the show notes as well, too. And being an industry thought leader and understanding the market, you just described some very good differential. I went to Oklahoma State, so you just kind of have a little issue there.
All right.
And so you talk about some differential knowledge of different things. And what are some of your thoughts around that family office conference that you went to, because you were invited on a panel in order to speak? Tell us about that, because family offices, they've got some big concerns right now.
Yeah, I mean, this is the second time I've spoken on. It's an organization called IVYFON. It's an interesting name, but this time they had a family office event, 2-day event, which was part of the South by Southwest, and essentially it's targeted towards family offices, and they have multiple different panels, so on a broad range of topics. One of them, obviously, being energy. Obviously, that's the panel I was invited to participate in. So, I think the family offices are always, they're obviously, there's a lot of capital inside family office networks these days. So they're obviously always looking for places to place their capital. Interesting stat is the majority of the capital inside, family offices goes towards alternative assets. They're not really placing a substantial amount of their capital into stocks or bonds. They may have some hedging in there with some of that, especially on the bond side. But they do a lot of, and alternative investments is a very broad, that's a very broad, but they do a lot of co-investments, GP investments, hedge fund, private equity. And so, VC just depends on the family office. So it's a good place to get to meet a lot of different people, hear a lot of different perspectives, not just on your own space, but kind of how they view, investing into different markets, kind of what their key points are, their key metrics are. I think the family office space is not the easiest space to break into to raise capital. Can't say that we've actually had success in that, but I learned a lot going to those conferences, and I always like getting a chance to talk about energy. So, and that's always exciting for me.
Oh, it's kind of fun when I can get to visit with you. And we had dinner that one time, and as soon as the word energy and oil and gas is mentioned, you're like, boom, you change and you're in your zone because you're a true entrepreneur and understand taking care of things. I've had the pleasure of actually working with folks in different areas, and everything from the family offices to private equity. And I've seen some really lousy structured deals. Your expertise, you and I have talked about your expertise in looking at different mechanisms or buying or different kinds of funds. And I like yours because it's structured actually for the investor. Tell us a little bit about your thought process and what you've really got down in the new structures that you've been building.
Yeah, I mean, honestly, it's not that complicated, but really the genesis of it, and when looking at the opportunity to do something in this private investment space, the Reg D space, whatever you want to call it, really comes out of being on the other side of the table, in the sense of there's the capital raising portion of businesses, and then there's the asset development, asset evaluation, business development side of oil and gas as well. So, after 15 years, specifically Jared and I, of building processes around, evaluating different opportunities or different plays that come across your desks, you kind of start to get a good feel for what are some of the key points in terms of structure that are going to give you the opportunity to succeed. So, so the very, very short answer to that is the thesis that we really came up with. It's not, I don't want to came up with, it's not rocket science. It's simply, when you're in oil and gas, especially, but quite frankly, in any private placement or direct investment deal, in my personal opinion, one of the biggest things any investor should look at, whether it's oil and gas, whether it's Bitcoin, whether it's anywhere in the commercial real estate space, I don't care what you're investing in, you need to look at the fee structure of the deal, specifically the fee structure up front. So essentially, of your money that you invest, it's called a dollar, how much of your dollar is not going into the investment? And so if you take $1 and someone takes 20% of that, takes 20 cents of that, you're already starting significantly in the hole. So you've got to get a 20% return just to get back to where you started. So the upfront fees are, in our opinion, very critical. And when you run deals through asset evaluation in oil and gas, the other part of this to prove this out is we've run so many deals, models that had significant fees up front, and they never work. So they can work if you want to give very, very rosy predictions on EURs, or which is how much oil or gas you're going to produce from the well, or if you're going to assume, high gas prices or high oil prices for the life of the well. And again, those are not ways, those in our opinion are not risk-based models, and eventually are not going to perform. So it doesn't assure that you're going to have a proper investment or a good return on your investment. But in oil and gas, it's one of the ways, in our opinion, that you have the best chance of statistically having a better chance for the client and the investors to get a good return on their investment. So one, it's how much fees are up front, from a mathematical performance standpoint. That makes it very difficult if a decent amount of your 10, 15, 20, I mean, we've seen deals as high as 35, 40%, believe it or not, upfront being taken out. I also believe that that's a big misalignment of incentives, in the sense of, if I'm making all my money up front, regardless of the performance of the asset, how does that make me aligned as the GP? So again, that could be a commercial real estate deal. If you're in a commercial real estate deal and you're not aligned with the GP, I would say you might want to consider not making that investment. So that was kind of one of our main thesis in starting Invito. We wholeheartedly believe that that's how deals have to be done. It makes Invito a long-term play for us, because the way we will be successful at Invito is from the performance of their funds, because we share in the revenue of the funds. So if the funds do well, we'll do well.
One of the things that's going on is, with the bank failures and everything, you take a look at last year, Occidental Petroleum was the number one investment on the S&P 500. And people are really looking for energy in order to get to that somehow get some kind of hedge against inflation and try to get your money out of a bank, because I think that was really the run on SVB was a total eye opener for folks. As you take a look at everybody's got a phone now, and everybody can bank from their phone. And I think it was just amazing how much money, 42 billion, or see, where was it? And it was they had 72 billion in assets, and they had so much money coming out. And then they had all their money invested in bonds or in the other materials, and didn't pay attention to it. So do you as a family office, as an investor, have to now go do due diligence on your bank? I mean, that seems a little stupid. So,
well, I mean, look, I will tell you that I had a conversation with our bank after that. So, and really just because you don't think about certain things to answer, to ask. One of the biggest questions I had, and I knew that it wouldn't be anywhere near where Silicon Valley Bank was. Silicon Valley Bank, I don't know what the accurate statistic is, but whether it was somewhere in the 80s or 90% of their deposits were uninsured. So they were a unique bank, right? I mean, their clients were all the tech companies. Their average deposit size was huge. Hence, 95% of their deposits were uninsured. That's not your typical profile of a bank. And they were lending into one sector. So obviously that was the real question I asked from our banker was where does our bank stand in uninsured deposits, which is they're 38%. So that's a significant different number. And of course, in terms of their risk profile, where our bank doesn't own any long-term maturities. So that's another question, obviously, because what's interesting, Stu, is there's a lot to look at with Silicon Valley Bank, right, and the other particular banks, but there's a multitude of things to blame, and there's enough blame to go around between the regulators, the management at Silicon Valley Bank. I mean, just unbelievable poor job.
They were asleep.
I mean, it's really kind of hard to understand what the thought process was there. But you do understand is everything we're dealing with today, not everything, but almost everything we're dealing with on an economic front today is not due to COVID. It's due to the response to COVID, right? So when you increase the M1 money supply by 42% in a year, and you kick off $6.5 trillion in programs and new money, deposits at the bank shot up. The money had to go somewhere, right?
Right.
Silicon Valley Bank's a perfect example. They had more deposits than they could invest into their tech clients, and they didn't have it. They didn't have any other place to put it. Right. And so they went out and they bought treasuries and bought mortgage-backed securities, but they bought duration, long-term mortgage-backed securities. Then they didn't properly hedge, which is crazy in the face of a rising interest rate environment, which, by the way, how anybody could know that wasn't the environment you were in. That's the stuff you understand. But again, you really don't think about the fact of when all of that money went into the system, had to go into banks, and banks have to do something with the money. If they don't have commercial loans to lend to, mortgage, into private mortgages to lend to, they go out and they went out, in some cases they put it to work and bought securities. And I think the majority of the banks out there do a much better job of managing their risk. I mean, Silicon Valley Bank was without a chief risk officer for 8 months?
Yep.
Which I heard was undisclosed, which again is kind of crazy. Or the fact that the CEO tried to sell stock a couple of days, or did sell stock a couple of days before the company went down.
It was the previous week, I believe. Yeah.
I hope there's some accountability there. But I think that fear sells. Fear sells, right? Fear gets eyeballs on TV. Fear gets people to read. Fear wins votes, and nobody's going to pay attention to 24/7 news networks or 24/7 business channels if it's boring, if they're not hitting any emotions. And all you had to do is turn on the TV or go on social media, and very good, well-intentioned people that I like, were posting stuff on LinkedIn or Twitter, and just speculating. And unfortunately, it just fosters fear. And of course, that is, particularly for the banking sector, can become a problem, right? Because runs on the bank are what sink banks, which is what Signature Valley or Silicon Valley. If people start to run to the bank and try and all get their money out, it's a self-fulfilling prophecy. You're worried you're not going to get your money out, but everybody running to get their money out is what causes you to lose your money.
Right.
So,
Steve, this is kind of funny because one of the articles that I had pulled was from one was from your Substack, and the other one was I pulled from the Wall Street Journal today. And it was everything you just talked about was in that article. And you had not even looked at that article from the Wall Street Journal. It was pretty cool. I'm sitting here kind of going, all right, Steve, thanks a lot. That's one of my points I was going to bring up. Thanks a lot, Steve. You just, and I'm going to have this article in the show notes. You had some really good points in there. Like in oil and gas investing, that's one of the big things that are out there in alternative investing is that you got to look for the tax deduction. There's a couple different ways to do that. In getting into alternative investments with a passive income and a tax deduction, oil and gas has still got that tax deduction in there, and taxes are going to go up. That's a huge issue right now for a lot of the investors I'm talking to, is because they're sitting there kind of going, holy smokes, we have 87,000 new IRS agents about to show up on your doorstep. So
right?
You know,
I remember if the new Congress has actually tried to put a stop to that, but there's a lot to unpack there that I would say is, I mean, look, this would be my advice to anybody, which is over the last, especially 2022,
right.
you're looking at your personal portfolio, and you're either managing it yourself or you're managing it with an advisor. Alternatives, I like to, the better word for me for alternatives is out of the market investments. So when you look at your investment portfolio, and I'm speaking from my own personal experience, by the way, when you're looking at your personal portfolio, if you're 100% in the market or 75% in the market or higher, look, if you have a year like we had last year, everybody fell in love with equities over the last decade or so because, we had basically a bull market for almost, really since what, 2009, after the 2008 collapse, and which was a, 15-year run of literally free money, along with stimulus packages dumped in there. So those days are, the ultra low interest rates are definitely over. I don't think that I'm not saying that we won't see rates go back down again because the Fed's a different story. But when you look at your portfolio in terms of managing risk, and depending on where you are in your stage of investing, meaning your age, right, how close you are to retirement, you can balance risk and balance returns, so that you don't wake up every day watching the market. Look, the S&P went down 20% last year. The NASDAQ, 34%. You know how much you have to gain back to get back that 34% if you were in the NASDAQ? You got to gain back like 52%. So even if the NASDAQ averages 13, I think it's averaged maybe 13% over the last decade or so, you're looking at 4 years before you're back to where you were.
Right.
What if there's another, market downturn there? Now you could have a year where it goes up 30%, but those ups and downs are tough to live with. The ups are obviously not. But, I don't think you're going to have another 15 years like you just had 15 years. So I think everybody should look at on their own or through their advisor of having a portion of their portfolio out of the market. That's out of the market. That umbrella is alternatives. Oil and gas could be a portion of that. Oil and gas has a different risk profile. You're not going to take 40% of your portfolio and put it in alternatives. Personally, I'm trying to head towards a 60-40 is dead. 60-40 stocks, bonds is dead, in my opinion.
Right.
I'm moving towards a 60% alts, 40% equities.
Right.
And then in my own, if I'm looking at someone's portfolio of alternatives, maybe you're carving out 5, 10, 15% for energy in there.
Right.
For direct energy deals. Now you can invest in energy in multiple different ways. You could buy an EFT. You can go invest directly into stocks. But direct energy investments have the huge tax benefits associated with it. Right. There's no way around that we're moving towards higher taxes, unfortunately, because you can't put $6 trillion into the economy, and the only way to pull that money back out is through taxes, and that's coming. That's why a lot of people are trying to do Roth conversions now, right? Which you can use direct energy investments to offset that tax bill. But if you can take your IRA, which is going to be taxable in the future at more than likely higher tax brackets, convert that today to a Roth, which means it'll be tax-free in the future. And if you can invest, if you have the ability to offset some of that or all of that with an energy investment, that's a good strategy. We've been working with a lot of advisors last year and this year on that strategy in particular. But when you do the Roth conversion though, it's, you're going to get a big tax bill. So you have to either pay it, have the ability to pay it, or find a way to offset it. So, energy does have that direct energy investments. You can go invest in Oxy or Pioneer, different. That's investing in the stock market, right? And the oil price may be good, the stock may be down, right? Energy last year was fantastic. The number one performing sector in 2022.
Right.
How was that? How was the energy sector in the first quarter of this year? Not good. Not good, right? Because oil prices, went all the way down to low 70s and 60s. right? And all this uncertainty, right?
Right.
So the recent kind of downtrend in prices is all based upon uncertainty, right? Are we headed to a banking crisis, which is going to collapse the economy, which will drop demand? Coming into this year, it was kind of like China recovery and Russia supply. Those were the two things everybody was watching. And then along comes a quasi banking crisis to freak everybody out. So,
I'm such a energy nut news junkie that there is right now. In fact, last week, the IEA, the International Energy Agency, even said they're short $4 trillion in order to keep up with just normal decline curves around the world. So, Steve, even if there is huge demand destruction going on because of the markets, the lack of demand, and all of those kind of things, I'm a little bit hesitant to put a number out there anymore, just because the world's so goofy and changed. But it is, you and I have talked about, as far as looking at deals. If you plan on lower numbers and you're profitable at lower numbers, good management, good numbers, I still see some great things coming around the corner for the American oil and gas. 50% of the oil that's generated in the U.S. is from private investors. I mean, private companies. I still see as between our news site and reading so much during the day, I see good things coming around the corner. Do I see $200 oil that they were screaming, a little while ago? No. Do I see $40 oil? No. But it's tough to put a finger on it again.
I mean, look, we're very bullish on the long term, and when I say the long term, over the next 5 years, and I would say 10 years too, but specifically over the next 5 years, we're very bullish on oil. We will. I'm not saying that we wouldn't do a natural gas play, an investment, but I don't think we would. A pure natural gas play. Not that there's anything wrong with natural gas. My only issue with natural gas is, and when you look at the physical market, specifically in the United States, we have so much reserves in this country for natural gas, it's crazy compared to oil. And when you look at a chart, so from a portfolio manager standpoint, right. And you look at a chart and you can look at natural gas prices over the last decade or 15 years and look at oil prices. And when you'll notice that when oil is down, and when I say down, let's call it sub 50, sub 40, it doesn't stay there very long.
No.
Okay. Natural gas can stay low, has had time periods where it stayed low, and I mean low, sub $3 for substantial periods, right?
Right.
Natural gas is trading below 2 today. 8 months ago, it was at $9.
Right.
So everybody was singing the tunes of natural gas last year and loving their distributions.
Yeah. But Steve, in all the financial modeling that I've been looking at and everything else, I understand why oil is needed for everything. You take a look around, everything is made in your office, everything in your home. Everything is made with oil. And the EMP operators that I work with, which would you rather sell from a production standpoint? $80 to $100 oil, and look at the volume and the dollar amount, or try to sell natural gas at all of that type of volume. You're going to have a higher volume and higher profitability in that oil space. Would you say that that's a fair statement?
Yeah, it's a fair statement. Look, again, it all depends on how you're investing into energy. If you're invested into public stocks, right? There's some fantastically well-run and well-disciplined E&P natural gas companies out there.
Right.
Same thing on the oil side, and same thing with companies that have a big mixture of both.
Right.
Which is, and then of course the majors are, fully integrated up and down the whole
Right.
line of whether it's, downstream, upstream, midstream. That's a different way of investing into oil and gas, and anything that's tied to the public markets. There's so much more that goes into what
Right.
you get from a return. But when you're doing direct investments, meaning literally your money is literally going, you are putting money into actually drilling the wells, producing it, the hydrocarbon and selling it. Our belief that's where we want to be into oil, because look, at that point, commodity price is a huge determinant of how well your fund's going to perform. There's plenty of other variables that go into that, metrics that go into the performance. But commodity price is obviously one that affects it substantially. So there are just a lot of bullish things in place right now to feel good about, oil over the next 5 years. And when I say feel good about it, what I mean is I don't see us having any sustained periods of under $50 oil, certainly not under $40 oil, right? Because you've got the short term, right? We haven't even begun to fill the SPR, right? You've got
absolutely.
We've had so much underinvestment, so much capital has been pulled away from the industry. You go back to 2014, right? When at the beginning of the shale revolution, the shale boom, we had almost 1,800 rigs, I think, in North America. We're about 700 now. During COVID, we dropped down to 200, right? The inventory is an issue in the sense that, look at Pioneer, who is, widely looked at as having one of the best positions in the Permian, which is the largest producing basin in the United States. And, by their own admission, their own reports, 50% of their inventory is tier 3. So how much can the United States continue to grow? I think the projections were 600,000 barrels a day in 2023, only 194,000 next year. But I've read plenty of articles that at these prices, production is going to drop this year.
Right.
So, you've got a lot of capital been pulled away.
Right.
All the ESG pressures, you have regulatory pressures. There's just so many pressures on the supply side to oil. And the demand side, everybody is still projecting growth. And so again, if you look at alternatives, right, obviously electric vehicles will have a downward pressure on the demand side.
Right.
But, we're nowhere near that being, a big factor yet. But solar and wind are negative for natural gas, right? Because solar and wind produce electricity, and natural gas is used in a lot of places to produce electricity. So those put more pressure on the demand side, on the natural gas side. And then on the supply side of natural gas, not only do we have just ton of reserves in natural gas basins, but then you have all the associated gas that's produced from the oil wells. So I just feel more comfortable from a direct investment side to be in the oil side. And looking forward, I just think it's a great, for the first time in 15 years, I feel very confident about not having some crazy thing happen where we have low prices, absent another pandemic that shuts down the world, which no one can, nobody can account for that. We lost 15 million barrels a day of demand, no matter what, 3 months. So, which was catastrophic to the oil and gas industry, right?
I don't think that's going to happen. I think too many people are realizing that it was not handled correctly. So,
it killed the oil and gas industry. We have so many bankruptcies, CapEx budgets dropped by 50%, I think, year over year.
Right.
If you look at CapEx budgets today, historically, 25% of CapEx budgets are used for new discoveries.
Right.
It's about 10%.
Right.
And if you look at the amount of new discoveries that are coming online, it's a fraction of what it used to be.
Oh, yeah.
And again, when you look at the environment that oil and gas companies have to operate in, at least under this administration, it's not friendly at all. They just opened up the field up in Alaska, right, which had all the, all of the angst that Biden actually approved that. But then you go read some of the details, and I think he's like, but I don't know. Well, I can't remember the number, but millions of acres are going to be off limits. So it's like, on the one hand, it's like he's trying to appease somebody. On the other hand, he's trying to appease the other side. And then, at the end, nobody's happy.
Oh, no.
So
I'll tell you what, Steve, I hate to do this to you again, but I think I need to have you back because while you were talking, I thought about 14 different things that we need to talk about, but we're just about out of time here. What's coming around the corner next for Steve? What do you got coming around the corner?
Yeah, so we just launched our 2023 fund last week. So we're excited. It's a 25 million direct investment fund.
Nice.
And we kind of partner up with, we work with a lot of RIAs, registered investment advisors, and then we work directly with clients as well. So we're excited in our second year of having funds to get out there on the street, and a lot of good assets available. And, we're excited to get into year two and get to work. So, there's a lot of, again, alternative assets. Energy has a place.
Right.
In certain portfolios. I am not one of those guys that goes out there and tells everybody, direct energy investments have no risk. Everybody should invest into it. It works for everybody. It's a fit for everybody. It's just not true. It has a different risk profile to it, but it's a great way to manage certain tax liabilities. And it's a great way to generate passive income cash flow. So those two things are pretty intriguing and attractive to a lot of folks. So we're excited. That's what's going on with us.
That sounds fabulous. I'll tell you how people can find you on LinkedIn, Steve Blackwell.
Yeah.
And that's how you and I met. And when you sit back and take a look, also your website is?
It's Invito, Invito EP.com.
Fantastic.
I just authored an ebook on wealth and taxes and the effect of income taxes on wealth. It's a little short read, but you can download it off of our website. It's free. And so that'll be a living document. We'll continue to add to that as we move along. But, the number one destroyer of wealth is taxes. I hate to tell people that. Right. So there's no laws that says that you cannot limit what you pay in taxes. As long as you stay within the laws. Right. So there's lots of ways to do that. And not exploring those is just giving your money away.
Oh, absolutely. Well, Steve, thank you for stopping by the podcast today. I do appreciate you.
Always fun, Stu. Appreciate you inviting me. And I look forward to, retread number 3.
Oh, it's an honor to have you back.